for chapter
And speak up and look at the audience.
For chapter 1, we did
Thank you.
question 19, and what it asked us is to find the characteristics that affect the company's stock price. And so we found 6 outcomes that will affect the company's stock price. So 1 being characteristics of the firm, 2 would be the economy, 3 would be the economic shocks, 4 the business environment that the company is associated with, 5 the expected cash flow, and finally the current market conditions.
And remember, these factors that drive the stock price, if you were going to do a regression equation, those factors, you can build the factors within the regression model to forecast the stock price or the return on the stock price by taking factors from those elements. Okay? Go ahead.
Okay, so then the second question was asking what information asymmetry is and where is the inequity within information asymmetry. So information asymmetry is when one party of a business transaction possesses more information that is not available to the other parties within the transaction. And the inequity with this is that parties with less information will generally pay lower prices for goods and services or charge higher prices for their goods or services.
So information asymmetry is the cost of gathering the information. We're in a very efficient stock market. We have a gap accounting. We have lots of information. If you go overseas to other markets, they have very high information costs. And that's going to be reflected in very low stock prices because we can't get the information to really figure out what the stock is really valued at. Thank you. And who has that 2.8 and 2.15?
All right, so 2.8 was basically to define what a primary market is. So it's a financial market in which new security issues are sold by companies directly to investors. And then the second question, 2.15.
It basically just asks what is the difference between the main difference between money markets and capital markets. And it was that money markets are used for a short-term basis, whereas capital markets are used for long-term assets. And money markets are basically used for assets up to 1 year, and capital markets are used for assets with maturities of greater than 1 year.
So long-term bonds and stocks are in the capital market. CDs and money market mutual funds, those are money markets. Corporations buy and sell these notes, these money market instruments, in most cases to finance their operations and their inventory. Then they need to go to the capital markets, issuing long-term bonds or stocks to fund long-term assets. Okay, thank you. Yes, sir.
All right, so I had 4.9 and 4.12. So for 4.9, it's asking what the return on equity is, and it listed the total assets of turnover to 2.1, net profit margin is 7.5%, and equity multiplier is 1.90. The equation for the return on equity is net profit margin times total asset turnover times equity multiplier. So it came out to 0.29925, or roughly 29.93. For 4.12, it's asking what are the earnings per share and the price equity ratio. So the first thing we had to do was find the earnings per share, which is net income over shares outstanding. So that came out to $2.55 per share. And then the PE ratio is price per share divided by earnings per share. So that came out to $21.26.
Great. So you have the EPS, earnings per share, this one, times the price to earnings per share ratio is going to give you the value of the stock. Okay. So if the earnings per share goes up, the value of the stock goes up. If the earnings per share goes down, the value of the stock goes down. If the PE multiple, it's also called the PE multiple. If the PE multiple goes up, the stock value goes up. If the PE multiple goes down, the stock value goes down. This is the multiple approach. Okay. All right, thank you.
Alright, so we had 4.1 and 4.6, and 4.1 was asking to explain why the quick ratio is a better measure of a firm's liquidity than the current ratio. Then we came up with the quick ratio is a better measure of a company's ability to meet its short-term obligations because it doesn't include the company's inventories, whereas the current ratio does. And inventory is the most difficult current asset to convert to cash without a loss of value. And the quick ratio formula is the current assets minus the inventory divided by the current liabilities.
And then for 4.6, you need to find the debt to equity ratio, which is the total debt divided by total equity, which gave us 0.42. And then for the equity multiplier, it was the total assets divided by total equity, and that gave us 1.4.
Okay, so the debt to equity ratio gives you the leverage of the firm. And then the equity multiplier is going to give you how intense you're utilizing your assets on your sales. Okay.
So for 3.9, we were asked to find the net cash used in investing activities. The first one is they increased an investment by 36, so increasing it, we subtracted it from the net cash, and then they also funded fixed asset acquisitions with 109, so we also had to subtract that. And then the 14,215 was a marketable securities matured, so they got the money, so that's why it's positive.
Yeah, and then for 3.10, we had to find what's the net cash provided again by the financial activities. So at first, they repaid an existing debt, so then we subtracted the 31280, and then they raised additional debt, so then we had to add that here, the 650, and then they finally repurchased stock, so then we had to subtract that again, and we got a total of 292,670.
So when you do the financing activities, you're raising capital, and that's positive cash. Investment activities, you're buying assets, so you're using cash. Okay? Thank you.
Alright, so for 3.5, it was talking about the net working capital. So that's the current assets minus current liabilities. So you added cash, inventory, accounts receivable, and other assets, and then minus accounts payable and notes payable. And that gave you 6,655,610.
If you don't have enough net working capital, what do you do? So you're growing very rapidly, you're using up your cash. You don't have enough net working capital, what do you do?
Issue stock.
What? What?
Borrow money.
Exactly. You usually have a line of credit with a bank that's going to provide you with some liquidity.
For 3.7, we just basically set up an income statement for a Windows company. Then we put all their income and their costs into a sheet, and then you take the tax from 35% of this, which is this, and then you add it all up for their net income. That's it.
In your stock, in the stock worksheet, that scaling factor to use to get the portfolio weights, I used revenue. Can I use EBITDA? Instead of revenue, could I put EBITDA in there? You know, in the stock worksheet, there's revenues for each of the company that I put in, added up, divided back to get the weights for the portfolio. Could I use EBITDA, earnings before interest, taxes, depreciation, amortization? Could I use that instead of revenue? I used revenue. Could I use EBITDA?
Yes.
Yes. Could I use EBIT? Yes. Could I use net income? Yes. Could I use total sales? Yes. Those could be all the factors that you could use.
We worked on A3 and calculate how many installments of coupon payments you get, which is 6, because it's a 3-year semi-annual bond, so you get paid twice a year in it. And the coupon rate is 6.1%, so you divide that by 2, so 3.05. They said to just assume that it's $1,000 principal payment, and so that's where you get full value. And then so in the calculator, you just type in 6 with the N, 3.05 with the I, and then these are the coupon payments, which is $30.50 for the payment in T, and then for 1,000 type in FE, and it should come out this, but it didn't for me.
Pardon me?
It did. I didn't get this number, but this is the number shit.
Is it close enough?
I
Could
was
be a
off-
rounding.
I was off by like $20.
Oh, were you? Okay. It could be a rounding thing. Okay.
Okay, and then this one was a company issues $1,000 bond for 10 years at 14% annual interest. And it's a 0 coupon bond, so that means the money doesn't get paid till the very end. You don't get coupon payments. So for the formula, you have the price of the bond up here, and then you have 1 plus the semi-annual interest rate, and then you have the number of payments right here. So it's $1,000 plus, or over 1 plus the annual interest rate 14 over 2, and then the number of payments 10 years, twice a year. And then you get that, and you should get it $258.42.
And that was compounded semi-annually?
Yeah.
And if you were to do quarterly, how would you adjust it?
Well, you'd divide the 14 by 4, and then you'd multiply the 5 or the 10 by 4. Yeah.
Exactly. Great. And then what would happen to the value at the end? Would it go up or down?
It should shrink more.
Oh, the total value?
Or well, this.
Yeah, the more compounding periods you have, actually the higher the value is going to be. Okay, so when you go from annual to semi-annual to quarterly to monthly, the value is going to increase because it's compounding more.
Okay.
Okay? Great, thank you.
Okay, so our problem was less analytical and more theoretical. So this first says, name 3 forms of efficient market hypotheses. So first one is passive management, when they hypothesize that funds portfolios mirror a market index. The second one is semi-strong form efficiency, where neither fundamental or technical analysis can be used to achieve superior gains because all public information is calculated into the stock's current share price. And then the third one we found, which was weak form efficiency, states that past price movements and volume data do not affect stock prices. It's just 3 simple trains of thought.
So let me make a comment too. So the weak form basically states that I can do the graphs, of the stock prices. All the information is embedded there. I can't use historical stock prices patterns to be able to forecast or trade and make money off of the stock. That's the weak form. Semi-strong form basically states that I can look through all of the financial statements, calculate all the financial valuations. I'm still not going to make money because all that information is already taken into consideration within the stock price. And the strong form basically says that even insider information has already been leaked and is already incorporated in the stock price. That's the efficient market hypothesis, but we know that's not true. Technical analysis uses historical charting and has shown that you can make money off trading stocks on technical analysis. And it's also shown the violation in the semi-strong because we pour through the financial statements, and my students in this class have done stock valuations and have been extremely accurate in their projections in the stock values. And we also know that people who have insider information before the market can trade on it even though it's illegal and profit from that information because it hasn't been disseminated yet in the marketplace. So the efficient market does hold, but there are violations to it also. Thank you.
And then for 2.6, the question was like, what is the relationship between
increases during the business cycle and decreases during a recession.
Okay, so another way to look at it. Business cycles go in waves. This is your recovery peak period. This is your peak. Peak. This is decline. And this is the trough. The trough is also called, what's the trough also called? Recession. So as you start moving into the recovery and in the peak phase of the cycle, there's more demand for capital. That's going to drive interest rates up. As the demand for capital, because the economy is starting to decelerate, the demand for capital starts to go down and interest rates. And when you're in a recession, interest rates bottom out. Okay? So the other way to look at it too, we went over this the other day, is use the supply-demand analysis. And you use interest rates. So obviously, if there's more supply of capital, supply curve's going to shift out, quantity supplied shifts out, and interest rates drop. If the demand curve in the economy during recovery peak, the demand curve shifts out. Obviously, the quantity demanded shifts out, and interest rates go up. You go into a recession or decline phase, the demand curve shifts back, then the quantity demanded shifts back, and interest rates. So you can also look at it not only in a business cycle standpoint, but you can also use microeconomic analysis to arrive at the same conclusion. Who has a 9.12?
So in this problem, they were looking for the current stock price. They give you, within the stock price, they give 1 year forecast stock price, along with the expected dividend. So yeah, they give you P1, you have to find P0. So to find that to begin with, though, you set up this equation with first with the D1, but you have to find the growth rate first. So you solve for that. Once you get the growth rate, you can put it in with the dividend over the expected return over the growth rate you find.
So let's go through the more just stay there because you're doing 7-11, aren't you?
I'm doing 9-12 too.
So this is the Gordon growth model. This is Gordon growth. So if the expected return goes up, what happens to the price of the share? Okay, let's all try to do this. So if the discount rate or the expected return goes up, what happens to the price of the share? It goes down. Okay. If the growth rate goes up, what happens to the price of the share? It goes up. Got it. If the growth rate goes down, what happens to the value of the share? It goes down. And if the expected return of the discount rate goes down, what happens to the value of the share? It goes up. Okay. Up, up, down, down. Up, down, down. Up, down, down, up, down, up, down, up, down. You get it? It's a game. Okay. These are the laws of financial economics. Okay. That's how we value the shares. We're always asking, are the earnings per share growing? If they are, the price is going to go up. Are interest rates staying low and falling? If they are, prices are going to go up, and vice versa.
Then for 9.6, it just asks you what is the current value of the stock, and it gives you the annual dividend and the rate of return that you want to receive, and then you just take the dividend over rate of return, and you get the current value of the stock.
If you take the the dividend and divide it by the stock, what do you get? If you take the dividend and divide it by the stock, what do you get? You get the return. So that's dividend yield, okay? So you have to get comfortable moving around these equations, okay? Who's got 7-11? Can you write the CAPM equation to the left right there for us? And everybody needs to memorize the capital asset pricing model, okay? You need to memorize it. Just like you need to memorize the Gordon growth model and the perpetuity and the multiple and the discount. You have to memorize this stuff, okay? You can put it to the left there. Yeah, like right there. Can anybody tell me what the capital asset pricing model is? Can you tell me what the model is? Before she writes it up on the board? Can you tell me what it is? Can you tattoo it to your ankle so you never forget it? I'm serious. You can't forget it because they're going to ask you. They may ask you when you're working in the marketing department and they need you in the finance department. They say, well, have you ever worked on any securities valuation and do you know what the capital asset pricing model is? What's your answer? What's your answer? It should be yes, and you should be able to tell them. If it's no, then you're not going to work on the project. And it could be a project that would allow you to be able to get promoted and get a bonus. So because you forgot, they ixed you from the whole opportunity. So you got to be able to say yes. So what is the capital asset pricing model before she writes it up? Can you look it up? Is it in your pre-test? Just yell it out.
Risk-free plus beta times risk of the market minus risk-free.
Got it. Everybody get it? Risk-free rate plus the beta times the return on the market minus the risk-free rate. Okay, write that down and put it next to your bedside and memorize it every night before you go to bed. Okay, thank you. Can you move to the left a little bit, Reed? The other way. Perfect, thank you.
For 4.19, you're given 0.56 for the company's debt ratio, and you're asked to find the equity multiplier and the debt to equity ratio. So you plug in 0.56 to this equation, and you get 2.27, and then you use this equation to find the debt to equity ratio, and you get 1.27.
Now, is this a high debt to equity ratio? Is this company leveraged? It's leveraged, right?
Yeah.
If it was 2 or 3 times, would you be concerned? If the debt to equity ratio was 2 to 3 times, would you be concerned? Yeah. Would it be considered over leveraged? Yeah. Is it the company more risky? Yep. Okay.
For 4.21, you asked to find the profit margin, operating profit margin, and net profit margin for a company's the end of its fiscal year, and it gives you the net sales, which is 51.407 billion, and the net income of 6.
Can you point those out? Yeah,
net
perfect.
sales, net income 6.481 billion, cost of goods sold, which is 25.076 billion, and earnings before interest and taxes in 9.827 billion. And for gross profit margin, the equation is net sales minus cost of goods sold divided by net sales, which comes out to be 51.2%. And then the operating profit margin is earnings before interest and taxes divided by net sales, and that comes out to be 19.1%. And then the net profit margin is net income divided by net sales, which comes out to be 12.6%.
If I was going to build a forecast model using regression, could I use any of those profit margin ratios within my model to forecast the return on the stock? Would I use profit margins in my model to forecast the stock price or the return? Yeah. Would I use return on equity or return on assets also? Could I put those financial ratios in the model to forecast the stock price? Yep. Okay, so start thinking about how I'm going to use these to forecast the value of the company or the share price. Okay.
Yeah, so 4.22 is find the return on assets and return on equity from a company. So it gives us the net income of 9,054,000 get return on assets, you first need to find profit margin, which is net income over net sales, and that comes out to 3.53%. And then after that, you get the total asset turnover, which is net sales over total assets, and that gives you total asset turnover 2.44. And once you get these two numbers, you have to multiply them together, and it'll give you percent of 8.61%. From there, and that's how you get return on assets. And then from there, to get return on equity, you have to multiply return on assets by the equity multiplier. And the equity multiplier formula is total assets over total equity. So you take this, turn it into a decimal, and multiply it by equity multiplier, and it'll give you return on equity of 20.71%.
If I was asked to build a forecast model to try to forecast our return on equity for our stock, could I use the ROA and the equity multiplier as the two variables in my regression equation? Could I use those? Could I build a regression model if I had historical return on equity, ROA, and equity multiplier? Could I run a regression using those two variables to forecast return on equity?
I believe so.
Yeah, and if I could forecast the ROA and the equity multiplier for each quarter over the next 8 quarters, could I forecast ROE for the next 8 quarters? Yeah. So a lot of these things you can put into the regression model to do the forecasts. The ROE is the dependent variable. The independent variables is return on assets and equity multiplier. Okay.
Okay, so for 3.14, you're trying to find the cash flow of long-term assets. So how you find that is you do the current long-term assets minus the prior period, which was a year in this case of long-term assets. So all you have to do is they give you how much you have in 2014, which is 1,211,105, and the prior period was $990,560. So all you have to do is subtract 990,560 by 1,211,105, and you get that the cash flow of long-term assets is $220,545.
And that's the present value?
Yes.
Okay. So if the, so you're calculating the future value?
Yes.
Okay. I'm looking for a present value calculation.
Or no, this is the present value. Are you looking for?
Yeah, well, you're
That's
calculating.
the next one.
Oh, is it? Okay. Okay, go for it.
Yeah.
Oh, did you do it?
To.
The next problem?
Yeah.
Okay, go ahead.
So 6.2, that's our calculating future value, multiple cash flows. So this guy gets a certain amount of money every year, all these values here, and the interest rate you guess is 7.65%, and so you see year 1 here, I'll have it 4 times.
Is it it looks like you're using multiplication and not dividing by the discount factors. That's where I'm confused here. So you're taking the 2350 and multiplying it by the 1.0765 to the 4th power?
Yeah.
Is that correct?
Yeah.
So you're getting the future value?
Yes, I believe.
Okay, so how are you getting the present value?
Give it to us.
It gave you the present value? Oh, you didn't calculate it?
It gave us all the numbers.
Okay.
So this is all time future value, and add it all up, and it ended up being.
Okay, so that's the future value. On Tuesday, I'll do a present value calculation. And then what you may want to do is you may want to pick one of the problems from the exam. And maybe in a group of 3, pick a problem from the exam. And we'll work on those. So next week when we do the exam, we'll do problems and we'll do the exam. And then we'll have that done. Okay? So maybe go ahead and take a look at the problems at the end of the exam and see if you can work through them. Okay?
My resume is pretty much useless. I just worked at the same place for 3 years.
Wasn't it construction or something?
Sorry about it.